Hi, I'm Ben Wallace, Chief Market Strategist at Grimes& Company. As we close out the first quarter of 2026, markets were dominated by headlines around military action in Iran and the sharp rise in oil prices. Yet against this backdrop, many have wondered why the stock market has held up relatively well, with just a 4% Q1 decline. While those oil price headlines captured attention, the underlying drivers of the market have been more nuanced. In this update, I want to talk through three key ideas. First, what the oil market is really telling us. Second, why interest rates remain the critical signal. And third, how interest rates ultimately drive stock market behavior. Let's start with oil. During the first quarter, oil prices rose sharply from about $57 per barrel to over $100. At face value, that kind of move would typically signal rising inflation and pressure on economic growth. But the broader market is interpreting this differently. This chart compares the current price of oil in black with the price 1 year in the future in blue. The key takeaway is the unusually large gap between the two, shown in red, known as backwardation. Normally only a few dollars, that gap widened significantly, approaching $30 per barrel. This tells us that while oil is expensive today, markets expect prices to come down over time. In fact, in late March, spot prices continued to rise while 1-year forward prices actually declined. So despite the headlines, the current oil price surge is being viewed as a short-term disruption tied to geopolitical risks and temporary constraints around the Strait of Hormuz. For investors, the point is simple. Markets are reacting to expected future prices, not just today's price. That is why they are acting as if oil is up about $10 a barrel from 60 to 70, not from 60 to 100. Turning to interest rates, this is where the more important market signal comes from. This chart shows the 2-year Treasury reflecting Fed expectations and the 10-year Treasury reflecting the broader economy. We compare them to the hot economy, tight Fed, and cool economy, loose Fed ranges, centered around a neutral level of about 4%. From February 27th, the 10-year rose nearly 0.5% to around 4.4%, reflecting an economic outlook with higher inflation expectations. The 2-year also increased, signaling a shift in Fed policy expectations from 2 rate cuts in 2026 to none. We saw a similar dynamic last year amidst the Liberation Day volatility as interest rates rose even as the stock market declined, weakening both stocks and bonds, signaling the risk of a stagflation-like environment. In doing so, this helped to curb policy actions, signaling to policymakers to rein in those plans. This year, it's signaling the risk of higher energy prices. The key takeaway is that bond markets are pricing as an early warning system. By pricing in a policy risk, they can actually cause policy to shift. And since rates already adjusted to the tighter Fed 2-year and inflation risk level on the 10-year, there's a potential for rates to come back down and be a tailwind. This brings us to the most important point: how interest rates affect stocks. Despite the geopolitical headlines and oil price surge, equity markets have been relatively resilient. The S&P 500 declined modestly, about 4% during the quarter. So why didn't stocks fall more? The answer lies in the relationship between interest rates and earnings, which can be seen in the third chart. This chart shows the earnings yield of the S&P 500, the 10-year Treasury yield, and the equity risk premium between them. When that premium is high, stocks are attractive relative to bonds. When it's low, stocks become more sensitive to rising rates. Right now, the premium is near the low end of its historical range, making stocks particularly sensitive to interest rate moves. During Q1, a higher earnings yield from profit growth initially helped to cushion the impact of rising rates. But as the 10-year Treasury approached 4.5%, within range of the S&P 500's earnings yield, stocks came under pressure because that's when the premium heads towards zero. So even though oil prices were rising in the first few weeks of March, stocks stayed resilient until the late March rise in interest rates triggered a stock market reaction. This is the key framework. Oil influences inflation, but it's forward, not spot rates to watch. Inflation influences interest rates, and the interest rates drive stock valuations. As we look ahead, the key variable to watch is the direction of interest rates, particularly the 10-year Treasury around the 4.5% level. If rates move higher and remain elevated, that could create headwinds for stocks. But if inflation pressures ease and rates decline, that could support both the economy and equity markets. So while headlines may focus on oil and geopolitics, the more important signal for investors remains clear. Watch the bond market, because interest rates are what ultimately fuel stock market moves. If you have any further questions, don't hesitate to reach out to your advisor at Grimes & Company. Thank you for watching.